The COVID-19 market crash of 2020. Today, we re-diving deep into one of the most dramatic financial events in recent history. It was a time of unprecedented uncertainty, and the markets reacted in a way that left many investors breathless. But what was even more surprising was the speed of the recovery that followed. How did it all happen? Let's break it down. Picture this. It's early 2020. The world is just starting to grasp the scale of a new global health crisis. As countries went into lockdown, economic activity ground to a halt. Flights were cancelled, businesses shuttered, and social distancing became our new reality. This sudden, massive shock to the global economy triggered a wave of panic selling in financial markets. Between mid-February and late March 2020, major stock indexes like the S&P 500 plummeted by over 30%. To put that into perspective, it was the fastest drop of that magnitude in history. The VIX, often called the fear index, skyrocketed to levels not seen since the 2008 financial crisis. Investors were dumping stocks, bonds, and even traditional safe havens like gold, desperate for the safety of cash. The primary fear was that the global economy was heading for a prolonged depression, and nobody knew when or if things would return to normal. The economic data was grim. In the United States alone, tens of millions of people lost their jobs in a matter of weeks. GDP figures from around the world showed economies contracting at an alarming rate. It felt like we were staring into an economic abyss. But then something incredible happened. Just as quickly as the market had crashed, it began to climb back. So, what turned the tide? The answer lies in a massive, coordinated, and unprecedented response from governments and central banks around the world. Faced with a potential economic collapse, they pulled out all the stops. This wasn't just a standard response, it was a whatever-it-takes moment. First, let's talk about the central banks, like the US Federal Reserve. They immediately slashed interest rates to near zero. This makes it cheaper for businesses and individuals to borrow money, encouraging spending and investment. But they didn't stop there. They also launched enormous quantitative easing, or QE programs. In simple terms, this means they started buying up massive amounts of government bonds and other assets. This action pumps trillions of dollars of liquidity directly into the financial system, ensuring that credit markets didn't freeze up and that banks could keep lending. The scale was breathtaking, far exceeding the measures taken during the 2008 crisis. Simultaneously, governments stepped in with huge fiscal stimulus packages. Remember those stimulus checks? That was part of it. The US government passed the CARES Act, a multi-trillion-dollar relief bill. This included direct payments to citizens, enhanced unemployment benefits that often paid people more than their previous jobs, and massive loan programs like the Paycheck Protection Program (PPP) to help small businesses keep their employees on the payroll. Other countries enacted similar measures, from wage subsidies in Europe to financial support for businesses in Asia. This two-pronged attack of monetary and fiscal stimulus had a powerful effect. The flood of money stabilized the financial markets. It gave investors confidence that the worst-case scenario, complete economic meltdown, would be avoided. The stimulus checks and enhanced unemployment benefits put money directly into people's pockets. And with everyone stuck at home, with fewer places to spend money on things like travel, dining out, or entertainment, a lot of that cash found its way into the stock market. This created a unique situation. We saw the rise of the retail investor. People armed with commission-free trading apps on their smartphones and some extra cash started buying stocks. They piled into technology companies that were benefiting from the stay-at-home economy, like streaming services, e-commerce giants, and video conferencing platforms. This surge of retail buying added fuel to the market's recovery, pushing stock prices up even further. The market recovery was V-shaped, a term used to describe a sharp downturn followed by an equally sharp rebound. By August 2020, just 5 months after hitting rock bottom, the S&P 500 had already recovered all its losses and was hitting new all-time highs. It was the fastest bear market recovery on record. This rapid rebound was driven by a few key factors. 1. The sheer size of the stimulus was unlike anything we'd ever seen. It effectively built a bridge over the economic chasm created by the lockdowns. 2. The nature of the crisis was different. Unlike a typical financial crisis caused by internal market problems, this was an external shock. The market began to price in the idea that once the health crisis was under control, perhaps with the development of vaccines, economic activity could snap back relatively quickly. And 3, the outperformance of the tech sector played a huge role. These companies weren't just surviving the pandemic, they were thriving because of it, and their soaring stock prices pulled the entire market up with them. However, this rapid recovery wasn't without consequences, and we're still living with them today. Pumping trillions of dollars into the economy while supply chains were disrupted created a classic recipe for inflation. The prices of everything from groceries to used cars to housing began to climb, and central banks are now in the process of raising interest rates to try and bring that inflation back under control. This has led to the market volatility we've seen more recently. Looking back, the 2020 crash and recovery serves as a powerful lesson in how modern markets work. It shows the immense power that central banks and governments have to influence the economy. It highlights the psychological component of investing, where panic can give way to optimism almost overnight, and it underscores the importance of staying the course. Investors who panicked and sold at the bottom missed out on one of the most incredible bull runs in history, while those who held on or even bought the dip were handsomely rewarded. It was a stark reminder that market timing is incredibly difficult, if not impossible. The best strategy for most people is to have a long-term plan and stick with it, even when things look scary. The 2020 event proved that even in the face of a once-in-a-century global crisis, the combination of human ingenuity, policy response, and market resilience can lead to surprisingly positive outcomes. What are your memories of that crazy time in the markets? Did you sell, hold, or buy? Let me know down in the comments. I'd love to hear your stories. Thanks so much for watching. If you found this breakdown helpful and want to learn more about how finance and the economy work, please hit that like button and make sure you're subscribed to the channel. Don't forget to ring the notification bell so you won't miss our next video. Until next time, stay curious and invest wisely.